Welcome to Mortgage Solutions Television. I'm Victoria Hartley, Group Editor at AE3 Media. The protection gap for all ages in the UK has been well documented. By 2032, due to the rising age of our population, a quarter of British people will be 65 or over. The financial pressures on this generation are unprecedented. The obvious wealth of the baby boomers aside, many over 50s expect to work longer, support and financially care for parents, and act as mortgage guarantors for their children. These increased responsibilities are putting huge financial stresses on an age bracket simultaneously making retirement plans. It's a heady mix. Our discussion today focuses on key strategies advisors can use to close this protection gap. We'll look at the role financial advisors can play to future-proof client finances and the tools at their disposal to help them achieve it. But first of all, I'm keen to welcome all of our illustrious panel today. First up is Stuart Tragheim, Sales Director, Engage Mutual, Gareth Herbert, Sales Director from Mortgage Advice Bureau, Emma Thompson, Life Office Relations Director from LifeSearch, and Terry McCutcheon, CEO, the Finance Planning Group. Huge welcome to you all. So it's fair to say that sales and protection among mortgage advisors have been falling since the market upturned again. I'm wondering, is this also the case for the over 50s? And in which case, how can advisors reverse that trend? Stuart, is that something I can offer you?
Yeah, sure. I think if you look at the macro sales volumes of all protection over the course of the last 10 years, there has been a general trend downwards. That's largely been stimulated by lack of mortgage business being written in the market, and also because the intermediary channel is basically the best and largest consolidator that there is on price. It's the biggest model that there is to drive prices down. That's then been combined with some structural changes in the market around product pricing, particularly relating to gender neutral rates, and also some complicated tax changes in the life market have meant that life insurers are taxed in a different way, which has also therefore had an effect on rate. So the market has generally been in decline over the last 10 years. The bit of the market that hasn't done that is actually the over 50s market until very recently. So if you go back again 5 or 6 years, the over 50s market was growing quite dramatically, largely driven by online and television advertising. It's a different way of stimulating the market to the traditional intermediated market. Over the last couple of years, though, the over 50s market has also been impacted primarily by the financial crisis, as fewer people who are over 50 have got enough money to be able to buy the policies.
Right. TV advertising is obviously an enormous driver. Is that something that's coming back at the moment?
We have seen quite a big increase in the first half of this year, actually, from the large players in the over 50 space in particular. Yes, we have seen some, and I suspect that'll carry on into the early part of next year as well. Okay. But it's more likely to be people trying to protect market share than actually driving new volumes into the market.
Okay, so to hand over to advisors in which case, and I'm wondering particularly for our panel here today, all advisors, Stuart accepted, how advisors can actually reverse this trend? One day, Gareth.
I think the first thing is to reverse the trend, the advisors need to communicate with their customer base. I think direct sales in the past has meant that advisors had a certain skill base around protection selling. Unfortunately, I think some of that's gone. Okay, and I think having a client bank that you can bring to life using technology, using interactive newsletters, using proper reviews, rather than ringing a client when they choose to have a remortgage, family events, speaking to their client, owning that client bank and deserving that client bank is probably where advisors need to start looking at. Controversial maybe, but true. If they did that, that engagement would help in any market, not just the over 50s market. Okay, so I do feel that the answer is with the advisors to take time out and look at their own client bank, come up with their strategy, grade their client bank and work with it. And I think once they do that, they earn that right, earn that respect, and guess what? They also get referrals from the marketplace as well. What a great place to start. So the market's already there, in my view, but they just need to work harder for it.
Okay, so advisors need to actually work with their own information and clean their own houses, really, in a lot of ways. That's something the panel would agree with.
I agree with Gareth on that. I think the key to looking at the clients and working out whether they need life cover is regular face-to-face reviews, regular face-to-face meetings, and people's circumstances change, and we've got a notable group of people in their 50s where their children have left home. They may not think they need life cover anymore, but actually their needs have changed. They may have changed employment, they might not have death in service, they may be self-employed, and they may still have large mortgages going into retirement. So yeah, there are opportunities for life insurance for over 50s.
One of the things I wonder is obviously that actually buying a mortgage or remortgaging is often the prompt or the trigger for these interviews. So obviously with these slightly older clients, how do you find them? Because if they're not necessarily remortgaging, how do you search your database, and what strategies basically should advisors be using to find this particular demographic?
Well, I think there's there are technology out there where certainly you can work on looking at your database, client login zones where they can see what they've already got in place, strategies around looking at their own personal wealth, looking at how much their house is worth, and communicating through that sort of platform gets the client more involved. Particularly technology plays a part, in my view. It should play more of a part. If the client can log in and look at one portal where they can see what they've got and be able to work with that technology, suddenly becomes easier to put things in front of that customer. Reviews, as Terry said, that's important, but more importantly, putting useful stats in there that tell the client what's going on. As they say, the new 50s or the 40s now, it's changed quite a lot, that market, and I think we need to realise that technology and being able to help that customer engage with us quicker and be able to respond faster is where I think we need to be looking at certain tools far more than ringing that client once every 2 years or on a remortgage event if that indeed comes up. I personally think it needs to be more consumer-led and sharing that with the client, and these login zones to me are crucial in the future in the way we engage with clients.
I think Gareth's right. If you combine technology with traditional methods of looking after your clients properly, which means picking up the phone when it's their birthday, sending them flowers when they get married, congratulating them on the birth of the child, there are loads of events during the lifetime of a client that you can phone up and talk to them, and by talking to them and arranging to go and see them and make the effort, you do a proper financial review, you find out if they've got any life insurance needs, but also while you're there you'll look at the family and you'll ask for referrals and other people. The other key thing is if you set policies up in trust as well, you've then got an opportunity of getting in front of 2 or 3 more trustees, and again once the trustees become involved and understand what you're doing, they're likely to ask if they can do a similar exercise themselves.
That's right, absolutely.
I think intermediaries can also take advantage and use the opportunity that the fact that these products do get advertised on TV. So, making sure that, your own websites actually cater for that. So if somebody is actually going onto the market looking for over 50s, you've actually got a space. It may not be that you end up selling them an over 50s product, but there are so many options out there for customers who are over 50, and a lot of the providers are now extending the term that cover is available to. Critical illness is now available for older customers as well. So there's a whole range of solutions that can be given to people over 50s who might only think that the over 50s contract's the only ones available, but actually some of them will be absolutely suitable for them, but there could be other options as well.
My challenge would be the over 50s plans are marketed really well on television, they're sent out, and the clients apply either online or by post and get sent Marks and Spencer's vouchers as a reward or a small prize. What they should be doing is have an advisor follow up and actually doing a proper financial review to see what their real life insurance needs are, rather than just letting them buy £10,000–15,000 worth of life cover off the shelf. So there's a huge opportunity there.
Yeah.
I think that's true. It's also probably worth recognising that the sort of people that tend to buy off the page aren't naturally interacting with the advice market currently. So, and I think that's an issue because you will end up with a shape of market which is fundamentally skewed towards how the marketing budgets get set. Yeah. So a number of life companies, not many, will allow the intermediary markets to sell and advise on both underwritten and non-underwritten products. Some won't, but some will. And I think that's really when you get the value of the advice, because if somebody does want to move into a non-underwritten simple product and they're perhaps time poor but asset rich, then it's a relatively straightforward thing to do. However, if there are more complicated financial needs and they've got inheritance tax or they've got long-term care issues to think about and those sorts of things, then that should always go down the advice channel.